Hi everyone, welcome back to the Moneywise. My name is Benhar. I hope you guys are doing well. So, if you are new to this channel, I'm Benhar and I live in Germany from more than 5 years now. And here I like to share my personal experience on the topics related to personal finance as well as investment opportunities in Germany. You might have observed in past there is a positive or there is an immense positive energy at the beginning of the year. For an example, let's say there is a certain set of people who would like to start something new at the beginning of the years. For example, someone would like to start out like working on their fitness, someone would be like to start something new business, some or updating their own career skill set. So there is also a set of people who would like to start their investing journey from the beginning of the year. With that theme, I thought to make a video and try and explain how to start investing in a Germany, as well as doesn't matter where you are, but we will be discussing different types of investor. So for example, there are a lot of different types of investors, but on a broader level there are three types of investor. Investor 1, who is a conservative risk taker. Investor 2, who is the moderate risk taker. And investor 3, who is an aggressive risk taker. So we will look into all these three types of investors and try to understand their strategies, what could be the strategy for each personality. And with the example of 1000 euro, we will understand how to build your first portfolio in 2025. So of course, there are also possibilities to start investing with minimum 25 euros. Investing in gold is also possible with 25. Investing in ETFs, investing in stocks. There are various different forms of investments which can also be started as low as 25 euros. But for easy example and how to build up your first 1000 euro portfolio, we would look into this topic into more detail. So I hope you watch this video till end, and let's get started. So let's look into the three types of investors starting with conservative risk. So conservative risk, as a conservative risk investor, the aim here is to preserve the capital, like preserve the investment. The expectations about return is really minimal, but the aim here is to preserve the capital, preserve the investments, and to just they are happy with the minimum returns. So let's take an example. What I am being a conservative investor, what I would be aiming to preserve my capital and or preserve my investment, but I would aim something 2 or 3% extra on top of the current inflation. Let's take an example. The current inflation is around 3%, and your returns, what you should expect is to be around 4 to 5%. Something 2 or 3 1 or 2% could be enough minimum returns. As like, otherwise, if let's say if you not aiming for any minimum return as well, helping your investments, so it will be like as much as like you're just keeping your money under the pillow, so it's not in working for you, it is not growing for you. So even if you're conservative risk investor, the aim is here is to maintain at least the inflation levels. Otherwise it won't be helpful for this type of investing. So that's what the conservative risk investor would do. And when it comes to investment strategy, the options are available are for government bonds, which is also called as a fixed income asset. And how much you should invest in this? It should be around 60 to 80%. So if you notice, more percentage would be contributed towards, or like will go towards the government bonds or the fixed asset instruments. So government bonds is the bond actually which is issued by any country. So let's say if you are living in Germany and the German government wants some money, they would be issuing certain bonds in the market, and that bonds will be open to investment for an investment. So what you can do is, if you wanted to invest in government bonds, you can go to the local banks and ask for that you wanted to invest in government bonds, and they are happy to assist you. The second option or second strategy here would be cash and cash equivalents, like holding a cash. So but around 20 to 30%, let's say 20 to 30% should be the cash portion. But we have to make a difference here, or important point is here is this cash or cash equivalents, it should be a separate from your emergency fund. So You might have we have to understand that emergency fund should not be the mixture of your cash and cash equivalents. This should be the separate, and emergency fund should be the different. And the third portion should go to around 10 to 20%, around approximately, to equity and ETFs. ETFs are exchange traded funds. You also have possibilities to invest in ETFs for the equity funds. So these are the investment strategies for the conservative risk. And if you notice, as we discussed here, the portion of equity is less because you're taking the risk is minimal risk. So your returns will be also based, would be also a minimum. And now look at, well, let's look for the how your risk tolerance, or like how your 1,000 euros would look like if you adapt the conservative risk tolerance strategy, or conservative in if you are a conservative investor. So around investor, so around 1,000, as like we mentioned, 70% to 80%, 700 should go to your government bonds, and 200 should go into your money market funds or ETFs or cash equivalents. Money market funds are the short-term funds. This is a bit complicated to cover it now, but if you have any question, you can write into the comment and I can make it separate video. But for now, you can think about a short term of investment into the cash market. And the low volatile ETF, like instead, if you wanted to, if you don't want to go to the equity ETFs, there are also low volatile ETFs in the market. There your 100 euros should go, or like should be parked into this all bundle of 1,000 euros investment. So if you look into this, the large cap portion here is, if you see, government bonds and government bonds ETFs. There are also ETFs available for the government bonds, and 20% cash. And this what the 1,000 euros will look like if you are okay to have a conservative risk tolerance, or if you are a conservative risk taker investor. Let's look into the next type of investors, or next type of risk taker. So moderate risk. Moderate risk, as the name suggests, it is a quite of a mixture, like a balanced, like you are aiming with a balanced return. So here it is balanced growth potential with stability and diversifying across asset classes. What does this mean? You wanted some returns, and you also wanted to preserve your capital or preserve your investment. You are able to take certain risk, but that risk should not be a really risky portfolio. You have to make your aim here is to make your portfolio diversified and well balanced, so that your growth is also potential, the possibilities of growing your investment is also there, and you're preserving your capital as well, or as well as investment as well. And what comes under the moderate risk investors, what options we have is to invest into certain funds, and what are those strategy, we'll see. So what should be your investment strategy? Some here is around equity ETFs. Dividend paying stocks or ETFs are also available in the market. There your strategy should be around 40 to 60%, so that you have a certain amount of cash flows, you have certain amount of inflows, which could help you to grow your portfolio size. So the second option is also fixed income asset. Now we have to, why the fixed income asset here is, which is also a bond, government. This is also could be a government bond. It could be a corporate bond. So in the first example where we discussed, what is government bond? Government bond is the bond where government issues, or they borrow the money. The government here borrows the money from the public, and they issue certain amount of bonds, and that's how you get invested, and on returns you get certain amount of interest out of it. So that part of should be 20 to 40% of your portfolio, on all around of portfolio, the fixed income assets, that is bonds or bonds ETFs also. And you have also possibility here to maximize return. You can have alternative investments like REITs. REITs is a basically real estate portfolios, a bunch of companies who invest into the real estate properties, and they get the rental income, and those incomes are further passed on to the investors. So that is a REITs. It could be ETFs as well. It could be REITs as a company, investing into the equity as well. So it could also happen that you can also directly, there are also certain platforms where you can start investing in the REIT products, and that company will invest into the commercial properties or the rental properties, and whatever the income comes from that properties, it will be distributed to the investor. So that's what the investment strategy for the moderate risk taker, because here we are aiming to grow our investment and also preserving our investment. That's why we have to segregate into three types. It's equity and equity ETFs, and the ETFs which could pay you a dividend, so that your cash flows you can reinvest those cash flows and build upon your maximize return that could give you a maximum return. So also the second component should be your 20 to 40% of fixed income, and alternative investments 10 to 20%. And now let's look how my 1,000 euros would look like if I'm a moderate risk taker investor. That's how my 1,000 euros will look like. 500 will go to equities. Equity, if you know how to choose the correct stocks, suitable stocks, because there are thousands of stocks into the market. But if you're not someone who doesn't know how to pick the stocks, I would prefer to invest in large cap fund ETFs, small cap or mid cap. So small cap would also be a riskier for some people who would be not that much aware of how to pick the small cap ETFs. That could be also risky, but the majority should be either, it would be better if you choose a equity ETFs which is paying you certain amount of dividend on a regular basis. You can also have a large or mid cap of ETFs, company large cap as mid cap companies ETF. So that your 500 should be going into that portion, and 300 around bond or bond ETFs. So and your 200 would look like will be segregated into the alternative ETFs. There are also ETFs which could provide you into the alternative commodities. Alternative, it could also be a cryptocurrencies, it could also be your certain REITs, as what we discussed previously. So that's how the chart will look like 50% equity ETFs, 20% of my will go into 30% will go into some around bond ETF, and 20% alternative ETFs. That would be the strategy for the moderate risk investor. So here my aim is to preserve the capital investment and to gain or to grow as into the balancing structure. So let's look into the aggressive risk investor type. So in this part of aggressive risk investor, his aim is to maximize growth potential, accept higher risk and higher market volatility. So the how much you risk takes, that much you returns you will get. So the higher the risk, the higher the returns. The lower the risk, the lower would be return. So your aim is to take as much as risk or higher risk for the higher returns. And we have to also consider, while building this kind of portfolio or strategy, there should be a volatile, because without volatile there wouldn't be maximum risk and there wouldn't be a maximum return as well. So this kind of instruments or this kind of investment strategies are a bit aggressive, and where you're aiming for maximum returns. And what options we have under this strategy is like, or how to build the investment strategy is, the investment strategy look like 70 to 90% would go to equities or equity ETFs, 5 to 10% cryptocurrencies, and 10 to 12% alternative investments. So here, if you notice, now you're willing to take a risk and your aim is to maximize return. That's where the cryptocurrencies would come. Again, equity ETFs, it can also be possible that you have 90% of, let's say you're aiming for 90% of it, you're aiming for the strategies, and yours, let's say example, taking 90% of equities or ETF, 30% I will put into large cap, 30% I will take put into the mid cap ETF, and small 30% to the small cap ETFs, so that my and overall equity ETFs covers entirely entire cap of market cap. So large cap I would be having 30%, 30% I will be having mid cap, and 30% I can have a small cap equity funds as well. And now I would be investing 5 to 10% into my cryptocurrencies. Cryptocurrencies, again, I won't invest. Let's say if I wanted to adopt this aggressive risk strategy, or being as an aggressive investor, I won't take cryptocurrencies, the one who are like meme coins. I would like to invest into the stable coins. Stable coins are the one who, like, let's say stable, which means like the stable cryptocurrencies, like you have a Bitcoin, you have Solana, you have Ethereum. I want to invest my money into a meme coins. Let's say any meme coins, there are thousands of cryptocurrencies, but I would be investing, even though my aim here is to take maximum risk, but I would take a risk only which is I'm able to manage. So that would be my approach for cryptocurrencies, to invest 5 to 10% into a stable coins, Bitcoin, Ethereum, and Solana, this kind of top 3 or top 5 cryptocurrencies. And the 10 to 20% will go into the alternative investments, which is also we covered in the previous slide, which is a REITs. REITs is a basically investing directly into commercial properties. Too much capital is required, but since here there are also possibilities that you can invest certain amount, let's say 100 euros per month or 200, or certain platforms where you can go and invest into the commercial properties, and whatever income rental properties the company gets, they will distribute it to the investors. So this would be my investment strategy. And how my 1,000 euros will be parked, or how my 1,000 euros will be looked like into, we will go into this. Since we are aiming for the higher risk and higher return, so this is how my 1,000 euros will look like. So 800 will be around 800 I would be putting into the equities or equity fund, or emerging markets, or as like I mentioned, large cap, 30% in, let's say 30% of 1,000 is like 300 into 300 into large cap, mid cap, and small cap ETFs, and private equity into the 100 euros. Let's say private equity is also a REITs, or alternative investments are also fall under private equity. Private equity is the form of investment where the companies are in an early stage. These are the startups. These are the companies which are not listed onto the stock exchange. So also there are also platform where you can invest into the private equities. That 100 euros should go into the private equity, and cryptocurrencies, as mentioned, into the stable coins. I would be putting my 100 euros into stable cryptocurrencies. So that's how the segregation look like, around 80% into equity market or emerging market, and 10% cryptocurrencies, 10% private equities. So that's how my 1,000 euros will look like into the what I so that's how I would go with my 1,000 euros, and that's how I would build my first 1,000 euros portfolio, adapting into either one of the strategy. Of course, I'm saying this is for information purpose also, because the money brings, or the investments are a bit personal, and these are generic form of investment strategies, which is not a personalized. So please understand your risk, please understand your the informations, and take decisions accordingly. Thank you. So that's all from my side today, and I hope you learned something new. I hope you watched the video till end. If you have any questions on these topics, or if you have any suggestions on this channel, please write me into the comment box, and I'm happy to answer them. And I hope to see you soon in the next videos. Until then, thank you very much. Thank you.